Yes, good morning, people. Good. Before we start the next set of our technical topics, like we discussed the last class, we're going to do something beyond exams for today. Yes, we're going to be doing a basic review of what a financial statements should look like, more from a company perspective. I'm sure all of you would have seen individual return filings because it's fairly easy. You could have handled it yourself. But when it comes to company tax returns, things are a little difficult, right? Because you have a financial statements given to you, you need to go through a lot of facts and understandings. And so based on my last 7 years of experience, let me show you what kind of data should I look into. Yes, all the things which I have learned in my past so that I have been able to review your financials. Not that I'm telling you I'll be complete 100% accurate, but at least my financial statements would also cover everything which an assessing officer would look like. Yes, so when an assessing officer looks like as to what and all is the data which he takes into consideration is what we're going to review for today. I'm going to see if you're able to match it to my extent. Yes, I'm sure you all would have prepared your own computations also, so you would have a high level understanding of how many adjustments you want to look at, right? Let me tell you the level of adjustments I will be looking at, and then we'll compare who is doing the most, right? I know when I've given you financial statements, it's not very obviously possible that you will get the final income itself in your hand because you may have queries to answer. Yes, so today's review is all about trying to find out what queries should I raise as a CA. So as an auditor, when you go to a client, what kind of queries should you be asking the client in order to get the final information in your hand is what we're going to discuss upon. Yes, at the same time, the financials which I may have for you right now would not obviously be having all the information that we are going to discuss about. Yes, so I'm just going to give you every single thing which I look into, whether it is there in this financials or not, so that if you see it in your financials, you're able to relate to it accordingly. Yes, that is what we're going to do in today's class. Can we? Yes, perfect. So the financials which I got from our friend is of a company called Shinetsu Polymer, which I'm assuming is a manufacturing entity then. Yes, it's a manufacturing entity. Now I'm taking into consideration the financials of FY 22-23, which probably is because the financials are not yet signed for the current year, so that's completely fine. Yes, at the end of the day, it's all about just trying to understand what and all should we be looking into and not preparing a number statement. Yes, so I'm going to look at the financials one by one, and we are going to discuss on each line item what do you think should be considered, what do you think should not be considered upon. Yes, good. From a financials perspective, the two important things which first come to you is your balance sheet and your P&L. But honestly, if you come and ask me, I don't review the balance sheet P&L itself. There is not much to collate information from balance sheet P&L because all magic happens in the notes to accounts. Yes, but there are still a few things here and there you should be knowing from a balance sheet P&L perspective. So that is what we're going to look into first. First, if I'm looking at the financial statements, the balance sheet P&L has been prepared as equity liabilities, which means my company is a AS company. My company is an AS company. I have not picked up an Ind AS company. Yes. Now, Rahul, is there any significant amount of differences between AS and an Ind AS company? Just a handful. Just a handful. One most important difference is that when you see an Ind AS company, you will find a new notes called as OCI. You'll find a new note called as OCI, other comprehensive income. Now, other comprehensive income, as much as you would have learned in Ind AS, is split into two. We have something called items which will be reclassified to P&L and items which will not be reclassified to P&L. If your understanding has been right on these two topics, people, you would understand that items to be reclassified to P&L are all those fair value adjustments, items which have no relevance to the P&L. Just to make your P&L inflated or deflated, we do some fair value adjustments, and income tax does not encourage or recognize fair value adjustments, which means any items which is shown as will be reclassified to P&L should be ignored, not part of the discussion itself. When it comes to items not reclassified to P&L, there is one item which takes a lot of importance in income tax. One is something called, any guesses? What are the items you have seen in not reclassified to P&L? No? No. There is a standard called as employee benefits. And employee benefit standards come and say when you have any post-employee benefits, items like gratuity and all those things, what happens is after you do a fair value adjustments, if there is any differential treatment which the valuer reports, any differential treatment which the valuer reports does not hit your P&L, it actually hits your OCI. And because it is hitting your OCI, that has to be taken into consideration. Because when you're doing a 43B adjustment, you're going to take the whole thing in consideration. You're going to take the complete balance sheet line item, and therefore OCI item becomes a tantamount experience there. Yes, so you need to take that into consideration. Although yes, your ITR 6 does not encourage it, which means it's a separate line item which you have to separately include. Otherwise, your 43B adjustment will go wrong. So that is one extra adjustment which you do in a P&L perspective when it comes to Ind AS balance sheet. Other than that, in Ind AS balance sheet, things which you have to keep in mind is in case you see some fair value adjustments. You unnecessarily see some fair value adjustments, you will take off all those fair value adjustments, you don't take them into consideration. Examples would be if you go to financial instruments in DS. Yes, when you give a loan to your employee, Ind AS basically requires that all the loans should be fair valued to an interest rate. Yes, but those interest rate are obviously not recoverable because you've given the employee at a concessional interest rate. So those extra interest and all which you're recognizing is not an income for you. You can treat them as a exempt component. Yes, at the same time you have a standard called as Ind AS 116, talks about leases, which comes into picture and starts talking some shit about ROUs. Yes, you take all your leases, you start recognizing it as right to use assets, you recognize something called interest on lease liability, and then you knock off things here and there by claiming depreciations. Yes, now at the end of the day you have taken a lease, which means you are not the owner of the asset. Depreciation as a concept does not apply to you, which means all those entries will be reversed off. You can't claim those as a deduction. At the same time, people, Ind AS financial instruments also has a standard called security deposits, where they say that if you're given a security deposit to someone at free of charge, obviously you're given a security deposit, you don't recognize any income on it. Yes, but Ind AS requires that you have to recognize notional incomes on those transactions also. So they will present value the whole security adjustments, and then they will recognize something called unwinding of interest. Again, all those are notional entries, all those don't come into picture. Yes, so to that extent, Ind AS, basically what I always do is when I see an Ind AS balance sheet, I will go and look into the audit adjustments, because audit adjustments will take into consideration all the Ind AS entries. I will immediately go to those Ind AS entries and I will reverse everything off. Yes, whatever Ind AS entries I'll see, I reverse it off, because those are all fair value entries. Other than that, if there is any Ind AS entries which are matching with the AS entries, I will recognize it as it is. Yes, so that's the first starting point I do in income tax, to reverse all your Ind AS entries. Are we making sense? Yes. Other than that, people, no changes in the Ind AS and AS, you can recognize it as it is. Clear? Yes, very good. Let's start reviewing the balance sheet first. We have something called equities and liabilities, which starts with shareholder fund, share capital, reserve and surplus, normal items. Let's look into the notes, you'll understand things better. Then we have something called non-current liabilities, where I see the person has taken a loan. This will have an impact. We will discuss on what the impact is. Then we have something called deferred tax liabilities. Tell me, people, from income tax perspective, deferred tax liabilities, relevant, not relevant? Relevant, not relevant? Relevant, not relevant? Absolutely not relevant. Absolutely not relevant, because deferred tax is nothing but the differential tax which is recognized in income tax vis-a-vis accounts. This is merely a timing difference. Has nothing to do with my income tax statement, which means I don't take that into considerations. Next, we have something called long-term provisions, current liabilities, trade payables. Notice there is something called outstanding due to MSMEs, and then we have outstanding other than MSMEs. This became critical last year when there was an amendment in 43B. There was an amendment in 43B which comes and says that when you have an MSME now, you have to make the payment within 45 days or 15 days oral agreements. If you fail to do so, then you will be liable for a disallowance. Which will be claimable only in the year in which payments are made off. We'll discuss about that. Yes, then we have other current liabilities, short-term provisions. With that, your liabilities is done. Then we have asset side, which has non-current assets, something like plant, property and equipment. Here is what you'll claim. Very good, you'll claim depreciation. We have intangible assets and something called capital work in progress. Tell me, people, from an income tax perspective, is capital work in progress relevant, not relevant? Is relevant, not relevant? Actually relevant, very silently. People, when an asset is capital work in progress, the asset is not put to use. And if the asset is not put to use, you can't claim depreciation. Now, this is something which you and I both know. What you don't realize is that when you have taken loan for this asset, the interest which is coming on it also should be capitalized, borrowing cost standards, and therefore you need to be careful to the fact that if there is any capital work in progress, you have to ask the question, has there been any loan taken for this asset? If the answer is yes, then whatever interest is there, you will have to check whether it is recognized in the asset account or is it taken to the P&L. If it is taken to the P&L, you will disallow it and add it to the capital work in progress. Yes, this is something which people fail to recognize at some stages, people, and becomes very critical because this invokes a disallowance. So be careful on this fact. Yes, next we have non-current investments. We have deferred tax asset, other non-current assets. Simple things called inventories, trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets. Nothing of extreme importance. We will discuss when we look at the notes carefully. Yes, good. Then we have what is called as a P&L statement. Now here is where your starting point comes for your PGBP computations. For your PGBP computations, first items you have is income, revenue from operations, other incomes, and then becomes your total revenue. We have expenses called cost of materials, cost of inventories, employee benefits, and finance cost, and then you have something called depreciation. You have something called depreciation. Now, if you look at the notes number carefully, people, all notes are in sequence. We have 4.1, 4.2, 4.3, except for depreciation. Depreciation does not have its own note, and sometimes what happens is, as an article, you end up missing it out because you're going through schedules, you don't see the depreciation schedule, you miss the disallowance. Depreciation will never have a separate schedule, which means depreciation gets disallowed at P&L stage, which means at this stage itself I will come forward and I will treat this as a disallowance. I will treat this as a disallowance. I will take it to my PGBP statement, start with net profit, disallow the depreciation here itself. Yes, yes. Good. So first adjustment which I would do. Then I have other expenses, and then I have profit before tax. Notice we have items like tax expenses, we have current tax, tax relating to earlier years, deferred tax, MAT credit. Is any of these relevant to you? Is any of these relevant to you? No, nothing of this is relevant because we always start from profit before tax. But this has given you a small hint. Hint is that the company has MAT credits. The company has MAT credits, which means in this case, you will now have to decide whether you would like to continue with the MAT credit by opting for old regime, or would you like to move to the new regime and forego my MAT credits, which is where we'll do the step 9, step 10, if you remember. Yes, I will check tax as per old regime. I will check tax as per new regime, and I'll check whichever is lower. In that lower, if my MAT credit is anyway getting wasted, I am still fine, because at the end of the day, my tax will become lower. That is how I'll check this off. Yes, so that is the second adjustment which I will ask my company. Yes, clear? Very good. With that, people, we are moving on forward to what is called as your notes to accounts. Now, normally as a person, do you have a practice to read notes of accounts? No, right? Yes, most of the people normally in the market don't have a practice to read the notes of accounts itself, and it's logically so, because mostly companies prepare notes to accounts from a accounting standard perspective, which fairly matches with my income tax ICDS also. Yes, so therefore to that extent we don't need to verify the notes to accounts. However, you need to be careful on a few places. Yes, place number 1, when it comes to Ind AS, AS or ICDS, there are some differences. Difference number 1, if anyone knows, there is something called ICDS 7, talks about no idea. ICDS 7 talks about government grants. Yes, and government grants basically comes and says in accounts that when you receive a grant, you can only recognize it at a revenue if you are confirming the fact that you will be able to perform the obligations. Income tax says even if you have not performed the obligations, but the money has been received by you, you need to recognize it as income. Yes, which means you will not be able to defer it off. That's one difference in ICDS 7, which means you need to be taking your notes to accounts into consideration and check if the company is receiving any government grants. If yes, you will go and ask the company, had you received any grants in the current year? And if so, have you recognized it already, or are you waiting on the obligation fulfillment? Point number 1. Point number 2, when we have ICDS 8, which talks about securities come and say that you should recognize securities as cost or NRV, whichever is lower. Same as inventories. Yes, there is only one problem. When it comes to accounts says you have to recognize cost or NRV, whichever is lower, at an security level, which means if I have asset A, asset B, asset C, I will check all of them individually. But when it comes to ICDS says don't recognize it on security level, recognize it on asset level, which means if I have 10 shares, I will accumulate the cost of 10 shares, accumulate the NRV of 10 shares, and check whichever is lower. Yes, so to that extent, you may have a accounting difference. These are some things which you need to keep in mind. Lastly, most important, people, when you come to ICDS 1 does not recognize the concept of MTM. Mark to market losses. Yes, so any kind of mark to market losses which you're going to have, which is going to be from a high value transaction, or if it's going to be from a risky business, they will say, I'm sorry, don't recognize this as a loss or an income. Take it when you settle the derivatives. Now let me clarify this. Just because you see MTM in your financials does not mean it is disallowed, because sometimes MTM is also recognized on your derivative instruments. You may have taken forward contracts, future contracts in order to settle your obligations of raw materials. Those are allowed. It is only for high value probable risky transactions, meaning I have taken derivatives as an investment. On those kind of scenarios is when MTM losses are disallowed, and that's not something which a company does normally, which means normally MTM losses are allowed unless and until you are in a investment business structure. Yes, in that cases MTM losses are taken away from you. Yes, so to that extent, people, it is always important that you read the notes to accounts, because it gives you insights on how the company's accounting system works. The one thing which normally does not happen in India, but sometimes I've seen it happen, is that in inventories, if you notice inventories, accounts would come and say you can use any method like FIFO, LIFO, weighted average. Then they have something called consumption method, machine usage method. Egapata methods irukku. However, when it comes to ICDS2, ICDS2 only recognizes FIFO, LIFO and weighted average, which means if you are recognizing assets on a different accounting system which is not recognized by ICDS, you will have to recompute your ICDS computation to match those adjustments of. Now, it doesn't happen normally, but if it does, then you have to be careful. All those things you can only identify when you read the notes to accounts. Yes, the one place where notes to accounts becomes extremely critical is in an industry called as real estate. Because there is what you start something called as construction contracts, and construction contracts ICDS vis-a-vis accounting standards are very different. They don't match the same. Yes, accounting standard gives you a different model of AS9, where they tell something called approved works, non-approved works, all those things get recognized in a P&L separately. ICDS does not recognize that. ICDS has a concept of percentage of completion method and project completion method, which means real estate's revenue recognition concept is very different than what AS recognizes. Yes, Ind AS is inno-worst. Ind AS 115 is very difficult when it comes to construction contracts. So if you're handling a real estate business with an Ind AS model, it's something you have to be extremely careful on how you make your recognitions of revenue. How the person accounts it in accounts itself is too complicated for you to figure out. Yes, you need to take it from there and then you need to recognize how ICDS looks at it. Yes, so if you have a real estate business, you're going to have a good amount of learning, but you're in the most riskiest business. Are we making sense? Yes, so to that extent is what notes to accounts helps you. Other than that, nothing critical from notes to accounts. Any doubts on this part? No? Good. Let's start reviewing the financials one by one to tell you what and all should I be looking into. Every time you start, people, if it's an AS company, you will be starting with something called as share capitals. You'll be starting with something called as share capitals. Anyone on the top of your head, people? Share capital pathone, what and all should you be thinking out? If you have share capital, what kind of thoughts should come to your mind? What kind of questions you should be asking your client? In the why change in the shareholding, why? What are you asking this information for? Okay, why are you asking this information? You need to get something out of it. No, if he says yes, what are you going to ask then? You asked him if there is a change in shareholding. He said yes. Okay, next. What is going to happen after that? That's revenue. Okay, you're doing it from an accounting recognition perspective. I'm asking from an income tax perspective. From an income tax perspective, what kind of questions are you going to ask and why for your computational perspectives? How does it help in income tax? Yeah. Don't give me tax or disclosures. No. People, the first two important things which happen here is when you see a shareholders, two questions you need to always ask. One, have you issued any further shares in the current year? The question is because when you have issued any further shares in the current year, income tax case laws, Supreme Court has passed a judgment which comes and clarifies any expenditures which you incur for issuing these shares, any expenditures which you issue for incurring these shares are going to be treated as capital cost, which means it cannot be claimed as a deduction. Any share issue expenses are a capital expenditure, should not be taken to P&L, and in accounts you will be taking it to P&L, which means you should disallow it. That's point number one. Preliminary expenses is when the business starts. I'm talking about you giving further shares in the current year. If you've done any FPO, right shares, anything of those sort, whatever money you're going to increase from those expenditures are fully disallowed. Yes, understand that only happens when you're increasing a capital base. If you're doing something like bonus issue and all, that's not a disallowance. It's only for increasing my share capital in the form of additional money inflow. Yes, basically IPOs, FPOs, rights issue, all those kind of things is where the first point is. So first thing, always check for increase in share capital. Yes. Second, also check for any increase in authorized share capital. Sometimes it may happen that the issued share capital may not change, but the authorized share capital may change. That is also a disallowance, because to increase your authorized share capital, you would have gone to ROC. You would have gone to ROC. The moment you went to ROC and you paid that expense for increasing authorized share capital, that's a capital expenditure, will be fully disallowed, not permitted as an expense. Point number one. Point number two, when it's a private company, this is a challenge for a private company. In a private company, if you're having losses, you need to ensure that your shareholders remain the same until the losses are exhausted. We have a section called section 79. Which basically says that a private company should not be passing on more than 51% of their shareholding. If you have passed on more than 51% of your shareholding, whatever losses you have will lapse. You will not be able to claim that losses. Yes. So you don't enter into any kind of business restructurings as long as you have losses. Those two are the most critical questions you should be asking as a company. Any doubts on this part? Yes. So these are the two questions which I ask if I'm looking at a share capital. Makes sense? Very good. With that, people, answers will actually come from here itself. If you notice, you have the company's shareholding structure is given to you. I need to ensure that the shareholders last year and the shareholders current year should not cross 51% transfer. Yes, if they do consider 51% transfer, I will treat them as a loss cancellation. That's point number one. Clear? Yes, very good. Then we move on to the next one, people, which is called as reserve and surplus. Do you ask any questions looking at reserve and surplus? Anyone? Any questions from reserve and surplus? No? Two questions which I used to ask. Now that I don't ask it anymore. First question was whether there is any securities premium increase. Until last year, 5627B was the concept. 5627B was angel taxation, where basically if you have issued shares at a premium, a closely held company, a private company, if they issue shares at a premium, you have to always check for the fair market values, because if you have issued it at a price more than the fair market value, that was an IFOS income. However, last year they deleted it off, which means it's no more part of your reviews of the current year. But this is financial year 22-23, which means in this year I would have asked that information. Yes, for FY 23-24 and FY 24-25 and onwards, I don't check for securities premium as an issuance. It was only for the past years, something called as angel taxation. Second most critical thing which I check for is always something called as capital reserve. Yes, because in accounts also what happens, people, is that when you enter into some large scale transactions, any large scale transactions, you have a tendency to put it under capital reserve. Yes, and that's the place where most of the people try to avoid taxes. Yes, now when it comes to income tax, I told you, whether it is revenue receipt or capital receipt, taxability is not decided based on your accounting. It's decided based on 224. Which means every time I see a capital reserve increase, I always ask the client, what exactly did you put inside? What's the nature of this capital reserve? Have you done any capital transaction on a high level? For example, people, of late, a lot of people do this waiver of loans. We discussed Mahindra case law. Yes, you have done a waiver of loan. Whatever income you have recognized, you are putting it under capital reserve because you don't want tax on it. Until last year, it was fine. Because you could put it under capital reserve, it was exempt from tax. But now that section 28 is amended, that is also an income, and therefore that should be recognized. Yes, similarly, like I said, if you have received government grants, but you have not recognized it in your books because performance obligation is not done, you would have accounted it under capital reserve. All those things should not be taken up. You should treat it as a P&L item. So looking at capital reserve is extremely critical because it has your capital receipts. Yes or no? Yes. One other thing which I always check for capital receipts is normally something goes to capital revenue reserve when you have undertaken a business restructuring. Items like amalgamation, demerger, items like purchase of amalgamation things. Yes, now when it is amalgamation and demerger, it's completely fine because it's going to be exempt from tax. But if you have done a purchase of a business, you are now accounting for slump sales. You're not accounting for slump sales. So looking at a capital reserve, you can go and ask a question to your client. Did you do any business purchases in the current year? If yes, was it a slump sale or was it an amalgamation or demerger? If it was a slump sale, did you do the net worth calculation? What is your capital gains arriving at? I as a CA have to give you a certificate for it. I have to give you a certificate for it. We have a certificate to be issued to the client for a slump sale transaction. That is a mandate. That is a mandate. All those things have to be kept in mind when you come and discuss about capital reserves. So there is a lot of things to be discussed in that. Yes or no? Yes? Yes? Any doubts? Ready to go? Yes? Very good. With that, people, you are done with what is called as it. Then we have something called long-term borrowings. Questions which you ask from a long-term borrowing perspective. Anyone? Questions which you ask from a long-term borrowing perspective. Has anyone asked any questions looking at this? Don't look at this financials. You generally, what questions will you ask? Anyone? No? 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 Two questions. Question number one, when you see a long-term borrowings, the first and the most critical question is, where is this loan coming from? Where is this loan coming from? Look at this balance sheet itself. This loan is coming from his holding company. Yes? Now, why is that critical, people? We are now invoking a section called as Durgesh sir. We're invoking a section called as, no clue? No clue. We are invoking a section called as section 94B. We're invoking a section called as section 94B. Anyone, any idea? Sorry? International tax is okay. What is international tax? No? No? 94B talks about thin capitalization. Thin capitalization as a concept basically comes and says that when you have taken loans from your related parties, you can't pay them interest more than 30% of the EBITDA. If you're going to pay them interest more than 30% of EBITDA, whatever interest you have paid will be disallowed. Yes, any excess interest will be disallowed. You can only pay up to 30% of EBITDA when the loan is coming from your related parties. However, even if the loan is coming from a third party, then also you should ask this question, because sometimes when the loan is coming from a third party in an MNC structure, your parent will guarantee the loan. And if your parent is guaranteeing the loan, then that is also treated as a 94B adjustment, which means even if you have taken loan from a local bank, but the loan is guaranteed by your holding company, interest coming from it is disallowed under 94B in excess of 30% of EBITDA. Mandatory disallowance to be made when you have such transactions. Look at the loan quantum itself. It is 943 lakhs, crores. Lakhs. It is about 9 crores. It is about 9 crores of loans. Now, obviously 9 crores of loans, people, 10% if you keep, then 90 lakhs, not a big number. But if it goes more than 1 crore, if the interest quantum in the current year goes more than 1 crore, you have a 94B disallowance to be triggered off. You need to be keeping that into mind. Yes? Yes. Second, when it comes to these kind of loans, people, you have to be very careful on how the loan looks like. Yes, sometimes it is loan, which is not a problem. But sometimes people are smarter enough. They have outstanding interests for a huge amount of time, which they have not paid off. 99% they'll go to the bank and they'll ask for a conversion. They'll say, change my interest into loan. Which means now there is no interest outstanding. There is only loan outstandings. Now, income tax has an explicit clarification under 43B. When you don't pay your interest on time, the interests are disallowed. And even if you convert this interest into loan, the interest will still remain disallowed until you repay the loan quantum. Which means if you have a loan which is coming from interest conversions, then that has to be tracked properly, because until the interest is paid off in the form of loan repayment, I will not claim the deductions. Are we making sense? Third, when it comes to foreign loans, you should always ask this question: why did you take this loan? What is the intention behind it? Because if you have taken the loan for buying assets from outside India, I'm repeating my statement. If you have taken a loan for buying assets from outside India, we then invoke a section called as section 43A. Anyone? No idea? Similar to borrowing cost, section 43A comes and says, when a loan is taken from outside India for buying foreign assets, whatever is the foreign exchange difference, not just on the asset but also on the loan, should be capitalized. You can't claim it in your P&L. Which means any foreign exchange gain or loss has to be now split into two. One, is it coming from any imported assets or is it coming from any normal things. If it is coming from imported assets, whatever gain or loss you have will have to be disallowed and taken to the asset cost. This is a mandatory adjustment and it's a critical one because your AS 11, which talks about foreign exchange differences, does not recognize this concept. Foreign exchange differences says once the asset has come to you, it doesn't matter whether it is a foreign exchange gain or loss, it is taken to P&L. But 43A does not recognize that. 43A will say take it off to your capital structure, which means that has to always be checked upon. Yes, so foreign loans have its own importance. You have to be very careful on that as a deduction. Clear with me? Yes, that happens first. Any doubts on this part? Yes, so three things which we check for people is 94B, 43A, and one more thing which I told you. Abhi to bola. And conversions. Three things you are not permitted to do. You're not permitted to do. Are we making sense? Shall we go forward? Yes, let's go forward. People, loans are given to you. They've also told you what is a repayment loan. So this is our foreign loans from your bank. Yes, so they're giving you how it works off, and everything is coming from a parent company, which means 94B triggers here. 94B triggers here. Yes, then we have deferred tax liabilities. We already discussed. Nothing is relevant, not important section. Then we have long-term provisions. People, questions which you ask here. What question will you ask? How does it matter? Which section? Huh? Very good. It's not about all employee benefits, people. It's about some employee benefits. Items like gratuity, pension. No, gratuity. Then bonus. Very good. Next, leave encashment. Very good. Yes, these three are the important ones which come from employee benefits. If you have any bonus, gratuity, or leave encashments, that triggers 43B. Yes, so when you look at employee benefits, you have to open up the TB. Open up the TB, break this open into multiple components and try to understand what component relates to what. If it is normal salaries, I don't have a problem. If it is normal expenditures, I don't have a problem. But if I see something called as bonus in this, if I see something called as commission in this, all those things will now trigger a disallowance. Because I have to make the payments before due date of ROIs. If you don't make the payment before due date of ROIs, those are getting disallowed. You can't claim that as a deduction. Section 43B. Very good. Yes, apart from that, you have gratuity. People, gratuity is also section. No, it is 40A7. It is 40A7. The one mistake which I've seen a lot of students making, people, and people don't end up understanding this, is that when it comes to gratuity actually does not have a time limit of due date of ROI. Gratuity's due date is 31st March. 40A7 comes and clarifies that if you have an unapproved gratuity fund, it is disallowed. But if you have an approved gratuity fund, then provisions will be only allowed up to 31st March. Payments made up to 31st March alone can be claimed as deduction. I've seen so many cases where people unfortunately are recognizing gratuity in 43B and are claiming deductions up to 31st October also. That's actually wrong. There is no provision in 43B for that. 40A7 is an explicit rule on it. Yes, which means you should not be claiming any gratuity post 31st March. That's not an expenditure which you should be permitting of. Yes, unfortunately companies are doing it and people have not been questioning it, but there can be questions on those, so be very careful on those as an adjustment of. Yes, next we have leave encashment, which comes as a part of 43B. This is what you have. Yes, then we move on to short-term provisions. People, what do you recognize in short-term provisions? What should you be asking? What should you be asking in short-term provisions? Nothing? Provision for? Why would you be bothered? Even if it's provision for tax, it'll go net profit after tax. Doesn't matter. Items which you recognize in provision for short terms, people, is something to be always asking to the client as to what is the basis of creating these provisions. Yes, sometimes you have items like provision for customer discounts, provision for warranty. All these kind of provisions don't hold any legal validity in income tax. Income tax does not recognize provisions. However, there was a Supreme Court judgment A Supreme Court judgment in the case of Rotok Controls came and clarified that you can have provisions in the P&L, but only if there is a scientific basis on it. If you have randomly recognized provision saying मेरे को नहीं पता 5% is a number, then it is not an provision allowable. You can only recognize those provisions which are scientifically proved of. Yes, so items like provision for warranty and all is a very standard question which any assessing officer will ask. He will straightforward look at provision for warranty and come and say, I will only permit this if you give me a scientific basis. Tell me on what basis did you arrive at this provision. If you can prove a complete calculation, he'll give you the claim. If not, expect a disallowance on this. Yes, so that is what is going to happen very critically in provisions for short-term nature. Long-term, there will anyway be no problem, people, because long-term is only going to relate to employee benefits, so it's still fine. But short-term can have a lot of things, especially for manufacturing companies. So you have to be careful on those as a adjustment of. Clear? Yes, short-term provisions, if I'm looking, people, they have only taken something called long-term debts, so they don't have any short-term provisions, but you have to be careful on those as an adjustment of. Are we clear? Yes. Everything. It's not on the borrowings, it's on the interest. So borrowings helps you identify that you have interest. Doesn't matter, because at the end of the day, you're going to go to your P&L, and in the P&L, there'll be an interest component. That interest is what you'll check for 30% of EBITDA. Loan is only going to help you assess whether you have 94B, nothing else. Clear? Yes? Good. Now we are moving on to trade payables. What questions are we going to ask? Very good. First question you're going to ask is on the MSME payment. This MSME payment will now have to be split off, people, and split off, like you have to come and check for 15 days and 45 days payment conditions. Yes, although be careful in this, income tax does not take disallowance on medium enterprises. While you say it as MSME, it is not MSME, it is only MS, which means they only have micro and small in it. They don't have medium enterprises in it. If you have any disallowance triggered for medium, that's wrong. You don't disallow anything on medium enterprises. You only disallow it for micro and small enterprises. That is what you do. That's something you know. What will happen in the others? What will happen in the others? Is there anything to question from the others' perspective? No. People, there is this very huge fight going on in assessing officer level. What he says is this is trade payables. Yes, and there is something called limitation of statutory benefits law. Yes, there is a limitation of benefits law where basically what happens is, a lot of times it so happens that you have a creditor to whom you have to make the payment, but you have not made the payment for, let's say, 2 years or 3 years. Assessing officer at this stage will come and say, boss, when you have not made the payment for 2 years and 3 years, why would the other person come back and even ask the money? In which case he will ask you to waiver it off. He will ask you to waiver it off, and he will ask you to recognize it in the P&L. He will ask you to recognize in the P&L. Now, this was happening very much in the past, where officers were coming and asking you for an aging analysis, and if they see that the creditors are more than 2 years, they will automatically treat it as a statutory benefits clause, and they will treat it as an income directly for you. Now, you may come and object, where you may say, no, sir, I know I have not made the payment to him, but I will still make it in the future, so I don't want an income recognition. They don't agree to it. They don't agree with it. Fortunately, courts have now confirmed it. Courts have now confirmed, saying that there is no such clause where you can start recognizing it as revenue just because the other person is not asking it. It is the discretion of the company. It is the discretion of the company. When the company is saying that they will make the payment in the future, they don't have any kind of obligation to recognize this as a revenue in the current year. So that's not something very important right now. The reason why you should be looking at it is, people, in an accounting perspective, when you have any government dues, that gets recognized in trade payables. Government dues like items like PT, professional tax, item like PF, items like ESI, items like LWF, labor welfare funds. All these items trigger 43B. All these items trigger 43B as an adjustment. Yes, because government 43B clause A also comes and clarifies any tax, duty, cess, anything paid under any law is also triggering disallowances. So you have to be careful on those as an adjustment also, which means you should ask for a breakup on this. Why does it happen that way, people? Because in income tax, there is, not in income tax, in labor welfare fund, there is a certain amount of law which says that if you have not paid the PT for more than 3 years, they will automatically transfer it to LWF. And the moment it is going and transferring to LWF, it becomes a 43B trigger until you make the payment. until you make the payment. So even though salary cannot be disallowed under 43B, an outstanding salary for more than a couple of years moves to LWF, and that becomes a disallowance. That becomes a disallowance. So looking at these notes are very, very critical to understand how the disallowance triggers off. Yes, yes, good. Next, we are moving on forward to what is called aging analysis. They've given you the aging analysis here. People, this aging analysis is helpful for you, not helpful for you? Is helpful? No, it's not helpful, because unfortunately you are not looking at 43B as on 31st March. You're looking at 43B post 31st March, because if anything has been paid off by 31st March, that's not important. Something which is not paid off by 31st March up to 45 days is what is the more critical part. So this technically does not help you. What you need to do is you need to take these trade payables and go back to your company and ask him for when did you make the final payments. If they tell you that the final payments are happening more than 45 days, that's what triggers disallowance. Items till 31st March are of no consequence to you. Yes, because even if you have an aging more than 1 year in the current year and you've paid it on 31st March, it is still a claim. The claim does not come when it is post 31st March. So I have not seen any benefit on the aging analysis as such, but my transfer pricing experts will not recognize this. My transfer pricing experts look at this schedule very, very importantly. Yes, transfer pricing experts would always come and say trade payables and trade receivables aging analysis is very critical, because it triggers working capital adjustments. It triggers working capital adjustments when you do an CUP method, TNMM method, and all those things. Material differences are taken into consideration by using this as an basis. Yes, a lot of cases what happens is, if you have any kind of receivable from your related party, an officer has a policy to come and ask, why did you not receive it within 30 days? If you're not receiving money from your related parties within 30 days, he will recognize that as a loan, and he'll come and say, boss, you're giving related parties loans indirectly in the form of higher credit periods, and they will start recognizing interest on it. Yes, to avoid those kind of adjustments, assessing officers be convinced by using something called working capital adjustments. We start convincing them, saying that, sir, this aging is not just for my related party, also look it for my unrelated party. For my related party also I'm giving 45 days, for my unrelated also I'm giving 45 days. Everything is making sense. It doesn't really matter. At the same time, when I am giving them credit period, I am also not paying on time. My trade payables come and say that I am also not paying my related parties on time, which means if you're triggering income for me, you should also trigger expense for them. So this helps you on working capital adjustments in TP perspective. That is how the critical part understanding happens. Make sense? People, अब तक जितना सिखाया सोचे भी थे क्या? No? Very good. Yes, at least it's a new learning for all of you. Good. Next, we have something called other current liabilities. Now, technically, I have never seen any kind of disallowance triggering from here. Nothing critical happens here, but let's just quickly see. You see something called statutory dues payable. Yes, it has happened here. In this company, they have reported it in other current liabilities. Some company reported in short-term payments also. Either way works. Yes, so they reported in trade payables or they reported in others, whatever makes sense. I have seen my companies reporting it in trade payables. They have reported it here, which means you have a clear understanding on this. Deposits. What is this? This is monies which I have taken or monies which I have given? This is monies which I have taken. This is a liability. This is the money which I have given. I have taken. Sorry. This is money which I have taken. Does it have any consequence? No. It has no consequence, because only money which I give is where Mahile case law will come into picture, and Mahile will say if you are foregoing deposit, then it becomes a capital expenditure. This is money is received by me. So if I do anything about it, it doesn't matter. Yes or no? Yes. However, if you are the one who's going to not make this payment back, for you now it is an income. That has to be recognized in P&L. So to that extent, yes, it is relevant, but not very critical. Not people recognize about this. Clear? Yes. Very good. Point number 3 says payable to employees. Any relevance? No, nothing of sort, except for, like we discussed, bonus, commission, and leave encashment goes into 43B. Next we have expense payable. People, any relevance? No, these are actual expenses, so there is no problem. You can have creditors. If you're following mercantile system of accounting, it's completely fine. You should not see any trigger from here. However, expense payable triggers section 40AI and 40AIA. Triggers 40AI and 40AIA, which is Very good. TDS defaults. Yes, people expenses payable is the most used ledger for accounting provisions. For accounting provisions, any bloody provisions you create just to decrease your profits hits my expense payable. And this is the ledger which officer will come and ask you to break open and show what the hell is this expense payable? Why have you not paid it off? At that point of time, if you say, yes sir, I've not paid it because due is next month, he will say, still, if it's expense payable, expense has gone to your P&L. Appo show me where have you deducted TDS. And most of the companies have a tendency to forget TDS on provisions. Most companies have a tendency to forget TDS on provisions. If you forget TDS on provisions, you are expecting disallowances. But that's not the worst part of it. You are also expecting interest on 201. They will treat you as an assessee in default and they'll start levying interest on you. Yes, so here is where you have to ask a question. Sir, have you accounted any provisions in the current year? If yes, did you do TDS on it? If they say no, take off disallowances. Take off disallowances. That is what the trigger point is going to be. Yes, people, if it's payments of current year, then it's not of a consequence. You don't generally ask too much questions. But if it's not a payment but it's showing on due basis, that's where the whole problem starts. Be very careful on those as an adjustment of. Yes, yes, very good. Next one says credit for expenses. Do you see a problem here? No, I don't see any problem here. It's a normal expenses sheet, not a problem. Credit for capital expenditure. This is nothing but your CWIP. This is nothing but your CWIP. Whatever is sitting in your CWIP, capital work in progress, has been accounted here as a creditor for expenses. Nothing critical as such, because CWIP itself is not recognized. Creditor also has no consequence. Clear? Yes, very good. Then we have short-term provisions. Items like bonus hits my 43B, gratuity hits my 40A7, leave encashment hits my 43B. This is how your short-term benefits look like. Clear with me? Clear with me? Yes, which means people, review of FS does not just happen by looking at P&L items. It actually starts from balance sheet. Balance sheet gives you so much insights than what your P&L can itself give you of. Yes, yes, very good. Then we are moving on to what is called as your asset side. People, the first asset which I'm looking at is plant, property and equipment. Hey, questions which you pick up from PP. Questions which you pick up from PP. One, the most important thing is you will find something called as addition line items. Yes, you will see all additions sitting here. You will see all additions sitting here. These are all your purchase amounts. These are all your purchase amounts, which means when you prepare your depreciation schedule, it is very important that this addition amount and that addition amount should match. If it is not matching, it can be only for two reasons. Reason number one, you have accounted for borrowing cost in income tax. Reason number two, I just told you there is something called 43A. You have accounted for foreign exchange loss. These are the only two reasons why your additions will not match. If anything else happens, then your accounting treatment is wrong. Your accounting treatment is wrong. It's a very basic thing to do, people. As an article, the first thing you should be doing is your addition sitting here and your addition sitting in your depreciation schedule should match. Only then should you start splitting them into more than 180 and less than 180 days. Clear? Yes. Anything else? Anything else? Deletions is of no consequence. Nothing from here. Anything else? No. The one mistake which students end up making, people, as an article, you don't realize the fact is your accounting way of recognizing assets and your income tax way of recognizing assets is different. A simple example I'll give you. When you buy a TV, LCD TV and all, where do you generally recognize in accounts? People don't have a tendency to report something called computers. People have a tendency to report something called electronics. Most of the accounting companies account it as electronics. They create a ledger called as electronics and everything sits inside, which means that ledger is now having computers also. It has TVs also. And for those who understand, computers is at the rate of 40%, whereas TVs are going at the rate of 15%, which means you should be asking for a complete breakup of your ledger to understand what are the nature of assets. Items which are not 40 should not hit my 40% schedule. The one horrible mistake I've seen so many articles make is they will take this electronics or computer ledger, whatever is addition, they'll directly put it in additions. They'll directly put it in additions for 40% block. Tomorrow when the officer asks for a breakup, that time they'll realize items sitting inside are mobile phones, TVs, LCDs, but items are sitting there. And all those items were never eligible for 40, they were always eligible for 15. Second mistake which students end up making is, people, when a company buys a software, they normally have a tendency to report it in intangible assets. However, you and I both know when it comes to computer software, they are at 40%, which means they should be reported under computers. They should be reported under computers. So you should ask for a breakup of intangible assets and then reclass all the computer software to computer block to computer block. These are two critical things which you should be doing as a part of the depreciation schedule, which means blindly putting the numbers is not the way to go. You should ask for a asset description breakup. You should ask for a asset description breakup. Are we clear? Yes, it happened in my company itself, people. When I joined my company itself, so many times it was happening that my companies would start reporting all these stupid things like mobile phones, CCTV camera, any kind of LCD monitors and all which we installed in office, everything is electronics. And my previous manager was reporting everything as 40% depreciation. When it came to assessment, I was scared because if the officer picked some information, then it is a illegal reporting. Now, at no point of time is it going to have a tax impact, because whether you claim 40 right now or 15 right now, eventually it will set off. Over the years, you will anyway claim it off. But today you have made a higher claim, which means for the current year, you're liable for penalties. You're liable for penalties. So those are not the kind of mistakes you can expect for yourself. Yes. So be careful on those kind of basic adjustments of. Make sense? Make sense? Very good. Apart from PPE, people, we are moving on forward to now something called as non-current investments. Questions which you ask from non-current investments? Any? Provision for? Very good. People, a lot of companies have this policy to recognize something called provision for diminution in value of assets. This is purely an accounting entry. This is purely an accounting entry which has nothing to do with your income tax statement. You have created a notional entry to be disallowed. Whatever movement you see in the provision for diminution in the current year will be fully disallowed. Very good. Next. Anything else? Nothing. What is not showing in this balance sheet but which probably should show people is that if you have any kind of investment in shares, you have a lot of issues. If you have something called as investment in shares, why, people? What and all issues are you foreseeing? Any foreseeable issues? Any foreseeable issues? Investment in shares triggers section 222. Investment in shares triggers section 222. A lot of things can go wrong in section 222. Dividends chapter comes and clarifies so many models where investment in shares can cause problems. For example, if I give you an investment in shares, like same example, imagine that was 0.25 to 0. Imagine if that was 0.25 to 0. Last year I had investment in shares, current year is showing 0. What question should I ask? Where did it go? Yes or no? Three things can happen. One, UK itself stopped the diminution. You could have disinvested. If you would have disinvested, this is a capital gains. You have to recognize CG. You have to recognize CG. He says, no, sir. Actually, company proposed a reduction in share capital. You are triggering 222. You are triggering 222. Reduction in share capital. 4C is a deemed dividend. 4C is a deemed dividend. 3. He says, no, sir. Company actually came forward and did a buyback. You are now triggering the new amendment of 222F, which says if you have done a buyback, then whatever is the shareholder is now going to recognize a dividend. These three activities can happen when you look at investment in shares. Fourth thing, if you are going to have an investment in shares, it is obvious that you're going to receive dividends. And if you're going to receive dividends, people, you can claim expenses. Only what expenses can you claim against dividends? You can claim interest expense. You can claim interest expense up to a maximum of 20% of the dividend income. Yes. Now, people, obviously, to know interest expense, you need to ask a question. How did you make the investment in shares? Did you do it by loan or did you use your own money? If you use your own money, then nothing is coming to you. But if you have taken a loan for it, you can claim 20% expense as a deduction under investments. Are we making sense? Yes. So investment in shares itself has 4 complications that you have to keep in mind before you proceed forward on things. Yes. Very good. Next, we have deferred tax assets of no consequence, and then we have other non-current assets. Look at the items. No, it says unsecured considered good. I have some all these assets are unsecured and considered good, which means I have not considered any provisions. Had there been any provision for doubtful debts, I would have disallowed. I am not recognizing any provision for doubtful debts. Movement and provision for doubtful debts also should be disallowed. should be disallowed. But notice, I see something called security deposit. Kya hai? Now I have made a security deposit, and if I have made a security deposit, I will ask a question: is there any movement? Is there any movement? If the increase is happening, then it's not a problem, because then you have given more deposits. But if there's a decrease happening, I'll ask a question: did you repay it back or did you forego it off? If you forewent it off, then in that case it is a expense which you cannot recognize. It becomes a capital expenditure. Mahile will come and say, please disallow. Please disallow. That is going to trigger here as a security deposit. Yes, yes. Last item, people see, there is something called IT due net of provision. What is this? These are your past refund dues. These are your past refund dues. Any questions that you ask from here? Very good. The question which you should ask here is, when you have received any refund, if you see the movement in the balance sheet, if it's an increasing movement, then it's not a problem. But if it's a decreasing movement, it means you have received refund of the past years. And when you receive refund, you automatically receive interest. So you should ask whether you have received any interest. If yes, then where have this been accounted? Where have this been accounted? Have you taken it to P&L? If the answer is no, that's a mistake. That's a mistake. Now this is one horrible mistake which happens from so many companies. Accounting team does not recognize it. Understand this carefully. As an example, I told you that in 23-24 I have accounted for a refund due of 100 crores. For a refund due of 100 crores. 99% what happens, people, is government will not straightforward give me 100 crores. They may end up giving some 98-99 crores. Probably because they have denied some TDS to me. They've denied some TDS to me. So what hit my bank account is 99 crores. Now what most of the companies team will do, they will say, oh, I had 100 crores to be received. I received only 99 crores. They will take the full 99 crores, knock off against TDS. And they'll say pending from the company, 1 crore. Pending in the company, 1 crore. What they did not recognize is 98 crores itself has interest, which means technically refund which you got was only 95-96 crores. The additional 2 crores was an interest, which means all should have gone to balance sheet is only 95 crores. The balance 2 should have hit my P&L. The balance 2 should have hit my P&L, which most of the companies don't do, because they will say, boss, paisa hi to nahi aaya. They realize the fact that money is not received by me, therefore they say it is not interest. That's the whole mistake which happens. Most of the companies make this mistake. Most companies, including my company, had made this horrible mistakes in the past, where they have recognized everything as a TDS refund without recognizing any interest on it. And the moment you stop recognizing interest, that is automatically going to trigger a demand. That is only automatically going to trigger a demand. How do you identify how much interest is due for the year? You intimation on the current year you would have got for last 5 years. No, how will you go and ask? You will ask all the 143 ones of last year. Most of the companies don't even keep a track of it. How do you confirm and be comfortable that yes, I have properly accounted interest and nothing is missed out? No, that's where the next problem starts. People, you think that when you receive the money, you will be properly doing it. So many times it happens, and especially in MNCs, it happens that 23-24 has a 98 crores of refund due. Now, if it hits your bank account, you know the facts. Then you can ask for questions. Most of the times what will happen is this company in 23-24 may have a refund, and in 2021 may have a demand. What happens? Auto adjust. 23-24 auto adjust to 2021, which means nothing hit my bank account. And the moment nothing hit my bank account, company did not even know. When the company did not know, what company did? They recognized nothing, because at the end of the day, TDS never came, so no problem. But interest came, not to your bank account, as an adjustment. The question which comes is, the interest which now came but not to your bank account, is it an income? Yes, 101% yes, because at the end of the day it was money received and then paid off. This is like application of income. And that's where the whole problem starts. How do you know that there is an interest like this? Because money never hit my bank account. Very good. It comes from AIS. People, when you open up the AIS, there is something called as a demand and refund sheet. If you click on the demand and refund sheet, it will confirm to you in the current year what and all demands were raised, what and all refunds were issued. It will not tell you the interest, but it will give you the breakup. That's already good enough. With that breakup, you can go back to the company and come and say, sir, for these years, question mark says that you have received refunds. Can you open up your mailbox? Tell me where and all is this? If they say I have not received a mail, you can simply go to e-filing portal. If you click on the e-filing portal, e-filing returns, if you click on that assessment here, it will give you the complete intimation list. You simply have to go download that intimation list and find out how much interest is showing inside it. This interest will need to be offered to tax, failure to do so, assessment 101% pick up now. Yes, they will not find it in IFOS sheet, they will automatically trigger a disallowance. This is something very important for an MNC culture. In an MNC culture, this gets missed out so beautifully well that officers now find so much of advantage to take it off you, and people lose so much cash here, so much cash. Yes, should not be making those kind of mistakes. So always use this carefully. Are we clear? Yes, very good. Next, we have inventories. Any problem in inventories? Nothing. It's always cost and knowledge which is lower unless you have changed your ICDS method accounting. Nothing is a problem here. Then we have trade receivables. People, problem in trade receivables is, like we discussed, you have provision for doubtful debts. If you see a provision for doubtful debts, trigger a disallowance on the movement schedule. Yes. Now, one thing which you probably need to understand, people, is when it comes to provision for doubtful debts, what's the easiest way to find the disallowance? Are you going to check my P&L how much is accounted, or are you going to check the balance sheet for how much is accounted? What is the right approach when it comes to provision for doubtful debts? Should you check for the movement in the balance sheet, or should you directly go to my P&L and tell what is the provision showing and disallow it off? P&L? Yes, very good. Horrible wrong answer. Yes, your P&L is the worst place to go and check for provision for doubtful debts, because if you recognize this carefully, provision for doubtful debts, let two things happen. One, you recognize your provision, at the same time you knock it off against bad debts. What hits your P&L is only the expense which you recognized. The bad debts knockoff which you did actually happened at balance sheet stage. Now, if you understand this carefully, when I accounted for the expense, I disallowed it off. When I'm reversing the provision, I should claim it. I'm repeating myself. When you accounted for the provision, you have to disallow it. But when you're reversing the provision, you should claim it. The accounting is sitting in the P&L, but the reversal is not in the P&L, which means you are doing a one-way disallowance. You disallowed the expense, but you forgot to claim the income. Reversal. You should have claimed the reversal, which means P&L is not the place to verify. It all happens at balance sheet level. Balance sheet gives you the most accurate decisions, because balance sheet will come and tell what is the opening balance, what is the closing balance, and what's the complete movement of it. The complete movement will help you recognize how much went to expense sheet to be disallowed and how much did you reverse off to claim. So don't end up doing one-way adjustments, people. That's a horrible mistake from your side. Clear? Yes, very good. Just keep that in mind. Trade receivables, like we discussed, that is how the aging analysis is going to be. And then we have cash and cash equivalents. People, what trigger points are you going to look at from here? आज तक कभी cash and cash equivalents verify नहीं किया होगा ना? Is there anything which you can trigger from cash and cash equivalents? You will check for something called as a cash account ledger. If there is any cash account ledger showing in the P&L, you will ask the question, tell me the daily statement sheet. You will look at the daily statement sheet and try to find out where and all have you made a payment more than 10,000 to trigger a 40A2. Very good. That's one. Next. Cash more than 269 ST. Very good. If you're going to have a transaction more than 2 lakhs in cash, then that also triggers a penalty. It doesn't trigger a disallowance, it triggers a penalty. Now, nothing you can do at computational level, but it's a warning for your client to tell him that, sir, you have received more than 2 lakhs, you are expecting a penalty. Next. Nothing. This is a very beautiful place to come and verify for what kind of deposits have you made. What are the nature of FDs you have created? Why have you created these FDs? If you remember one example I gave you, people, where what happened is, if you are going to receive share application money, you have to hold the share application money in a separate bank account. Yes, and I told you that whatever income you're going to receive from this special bank account should not hit my IFOS, should actually hit my net of share issue expenses. At the same time, if you created any bank guarantees, whatever interest is coming from the bank guarantee would be recognized as PGBP and not as IFOS. Cash and cash equivalents becomes a very beautiful place where you can go and ask your client, sir, what kind of FDs have you created? Give me the breakup of it. Why did you create this FD? If this FD was created because you are interested to do it, then it is IFOS. But if FD was created because client has asked for it, if the mandate of a law has come into it, then I will ask a simple question. Tell me how much is the interest from this account specifically, because that amount should never hit my IFOS schedule. That should hit my PGBPN, net of share issue expenses, net of share issue expenses. So that's the kind of question you can ask from a cash and cash equivalents as a question. Makes sense? Yes. So a stupid thing like cash and cash equivalents itself has 3 things to be verified upon. Yes, which is probably what we're not doing. Clear? Yes, very good. With that, your balance sheet is done. I think so. Yeah. Then you have short-term loans and advances, which has unsecured considered good, other advances, and then you have prepaid expenses and interest receivable. What is this interest receivable? Accrued interest from? Very good. Accrued interest from FD. Now, people, I don't know how many of you have this practice. I have this practice. Then when you have accounted for interest on FD in your P&L, I will always verify it with my AIS. I'll always verify with my AIS, because if your AIS has a higher interest and you have not accounted that much of interest here, you are expecting a notice. You are expecting a notice because department will come and say, what the hell happened? Yes, and that's very common to do, because problem what happens is when companies create FD for 2 years or 3 years, they will not recognize any interest in the current year because interest was never received. It all hit my bank account only. Yes, so they are not even aware about that much of interest. Here is where AIS helps, because the bank has reported interest for you. You need to go and tell your company that, sir, even though you have not received the interest, the money came to you in the form of FD. So in that case, you should be recognizing that interest as an accrued interest and you should be offering it as income. Failure to do so, can expect a notice. So verification of AIS here is very, very critical. It's very critical. Are we clear? Yes, very good. With that is what you have now done a balance sheet review. After all these struggles is when you complete a balance sheet review. You have not even started your P&L review. Yes, and if you think that, yes, Rahul, I can take 80 returns in a day and I can finish it off, you're not doing it right. You're not doing it right. Let me be very clear on this. Yes, for one balance sheet and P&L, you need to bare minimum spend at least 2 to 3 hours. Bare minimum you need to spend, because that's when you can collate all the English questions for your client's information. That is when the client will also feel like, हाँ बच्चे ने कुछ effort तो डाला है. Yes, yes, that is how the kind of extensive learning and understanding you need to have. Any doubts on this part? Learn something new? Yes, very good. Let's see how much of learning will come from P&L. Now, people, if you have done so much of analysis on a balance sheet level, P&L has very, very few information to be verified upon. You don't have much information to be triggered. But the first and the critical information, you look at revenue from operations. This is going to be your question mark to understand whether the company should go for, any person should go for presumptive or not. Now, obviously, you cannot do it for a company because it is only for individuals, HUFs and a firm. Yes, so it's not for a company, but nevertheless, revenue from operations becomes the first point to decide whether you're going for presumptive or no presumptives. Yes, so that is the first trigger which happens from here. Then you move on to other incomes, and here is where the whole difference starts. People, in other incomes, couple of items come. Like I discussed, any interest income comes, you need to ask whether it is properly accounted from IT, whether it is properly accounted from your FDs, and if it is accounted from FDs, under which head should I be classifying them? Yes, yes. Next, you have profit on sale of fixed assets. This is your profit on sale of fixed assets is a capital receipt, has nothing to do with my income statement. This should be exempt. You can't offer it as income. But at the same time, 2 things will trigger. Like he said, when it comes to assets, I will ask whether it is from a depreciable asset or a non-depreciable asset. If it is from a depreciable asset, the profit, the sale value itself will be reduced from my block. And if it is a non-depreciable asset, then I'll ask for the same thing. I'll ask for the sale value to determine the whole capital gain statement. Yes, understand, profit as such has nothing to do with you. Profit is not of any consequence, because profit is just the balancing figure. I don't want the balancing figure. I want the sale value. Block mein se what gets reduced is not the profit. What gets reduced is the sale value. I'm not sure why people qualified also don't understand this. Even qualified CS have seen this. Horrible mistakes they will do. They'll take this profit on sale of asset, remove it from PGBP and take it in depreciation schedule. What you're going to reduce from depreciation is not the profit, it's the sale value. You can't reduce the profit and all from the depreciation schedule. That's a horrible, horrible mistake. Yes. Now, Rahul, I don't know where the sale value is. Where can I find it? Yes, mein kaise rahega assets ka sale? Very good. the easiest place to find out is in the cash flow statement. If you open the cash flow statement, there is something called cash flow for investing activities, and in that investing activities, it'll come and say sale of assets, which means if the client by mistakenly also gives you the wrong numbers, you have a proof. You can go to the cash flow statement and come and say, sir, cash flow statement says 300 crores is the sale value. You gave me breakup for only 260 crores. Where the hell is the balance? Yes, that's a trigger point. That's the auditor question you should ask yourself to get the proper facts. Yes, which means addition comes from the depreciation from the PP schedule, and the sale value comes from the cash flow statements. You trigger both together, depreciation schedule will come out properly. That's how you should verify a depreciation schedule. Clear? Yes. Apart from that, like I said, people, if you have any liabilities written back, ask this question: what the hell is this liabilities written back? Is it as a capital receipt or a revenue receipt? If it's a capital receipt, then you will ask, why is it a capital receipt? Is there something which I can treat as an exempt income? If not, it all becomes a taxable PGVP income. Clear? Yes. Then we have cost of raw materials. Any problems? Any problems in materials consumed? No issues in materials consumed. We have the next thing called change inventories. Again, same thing, cost and NRV, whichever is lower. Problem comes in employee benefits. People, what and all questions should you ask at employee benefits level, other than what we have already discussed? Ignoring 43B. No? There is only one question remains. Personal expenses in employee benefits in a company, still a company expense. Sorry? We discussed, no? 43B aa gaya. Other than 43B. 36? What? Adanda. Same thing. Next. No. The most important things which students don't ask at a very, very junior level is a beautiful section called as section called as 80JJAA. Yes, any company increasing your employment are eligible for a benefit of 80JJAA where the employee cost is less than 25,000 per month. The cost is less than 25,000 per month. You have seen an increase in employment. You have paid all monies by permissible modes. Employee has been in the company for more than 240 days. You can take the employee's cost and claim it for next 3 years. As 30% deduction. It gets an auditor certificate, but at the same time a very beautiful section, something which you should always ask in a company. Yes, now understand this carefully. This is only triggered when you're a business. If you're a professional, then that's not trigger point. Yes, your CA firms and all cannot claim your article stipend as a 80JJAA benefits. That's not happening. Yes, but a company can definitely claim it as a deduction. So 80JJAA is a benefit which you should always ask and check for. You never know how much client can save in this. Yes, it's an additional weighted deduction given to the client, which means by incurring nothing extra, they are going to get a huge deduction out of this for the next 3 years. And that's a question which you should always ask. Apart from that, yes, one thing which you rightly said and we probably forgot is about PF and ESI, not the employer's contribution but the employee's contribution. Income tax says if you have any employee's contribution, it should be paid within the 15th of the next month. Failure to do so will trigger an income. It will be deemed as an income and added to your PGBP statement. Yes, anyway, that's not something very critical because it's part of tax audit. So it's anyway going to come in the tax audit statement, so you won't question too much. Yes, even if you forget it off, tax audit will come and give you the answer from there. So it's not a big deal, but nevertheless, yes, this is something to be asked upon. Clear? Yes, very good. Then we have finance cost. This is what I was talking about, people. When you have finance cost, unsecured loan and others, always ask the question if it is more than 1 crore. If it is more than 1 crore, you are expecting 94B. You're expecting 94B. At the same time, if it is a loan taken on an asset, then I will start using borrowing cost standards. I'll start using borrowing cost standards to capitalize all the interest cost. That is what I'm going to do for this. Clear? Yes, good. Last leg of things, we are in other expenses. People, the whole place where questions will come from. If you get a notice from department, this is the place where you will ask questions. Yes. Looking at each item one by one, people, what kind of questions will you ask? Business promotion. Very good. Business promotion is going to trigger a TDS section. 194. Very good. You're going to have business promotion with 194C, communication expenses. Communication expenses, basically all your broadband charges, internet charges and all. Does it trigger TDS? No, it doesn't trigger TDS. It's not liable for TDS. Next, we have labor charges. What the hell is this? Probably can be 192 or can be 194C, depending on what kind of contractual labor you have. Yes. Next, we have freight forwarding charges. True, but this is a manufacturing company, so they may have a labor to that extent also. You never know. Probably can. Yes. Then we have something called freight forwardings, people section. Very good. You have 194C coming here. Yes, your transportation charges will be triggered 194C unless the transport operator gives you a declaration that he has less than 10 vehicles and gives you his PAN numbers. Next, we have power and fuel. Nothing, not relevant. Yes, next we have bank charges. Not relevant. Next, we have rent. We have 194I. Next, we have vehicle hire charges. 194. Very good. Rates and taxes. This is the most important place to verify. Because here is where sits everything. This is the one ledger which any officer will ask for, asking for three things. One, if you have any penalties in it. Any penalty paid will be part of rates and taxes, and that's the question which he's going to ask, because he's going to disallow all your penalties. Next, he's going to ask if you have paid any interest under section 201, 234B, 234C. People, accounting rules come and clarify that tax alone can sit in my net profit after tax. If you're going to pay 234B interest, late payment of advance tax and all those interests, that should be part of rates and taxes. And therefore, even though it's an income tax related expense, it is not sitting in the below the line item, it is actually sitting in rates of taxes. So which means that also triggers a disallowance. And finally, all your registration charges, the ones which we discussed just now. Yes, if you're going to pay any kind of registration charges to ROC and all, that sits in rates of taxes, which means you look at the registration charges and ask the question, is it for increase of authorized share capital? Is it for increase of share issue expenses? All those expenses will then get disallowed. If you've asked it there, you don't need to ask it here, but nevertheless, this is the ledger which it hits to. Clear? Yes. Next, legal and professional. 194J, remuneration to auditors. 194J. People, this is the one place which, I don't know if you notice, is the place which will have the most provisions. Any auditor will, after completing the books, increase the fees, and that fees will go and hit as provisional account. Yes, and here is the place where you should trigger a disallowance, mandatory, because you have created a false provision and that provision has not been deducted on TDS. You are expecting a disallowance. Yes, I have always seen in every company, remuneration to auditors, differential is always a disallowance. If you have not been doing it, you are expecting a notice. That should be disallowed because it's an inflated provision, liable for TDS. Very good. Next, we have factory maintenance. I wouldn't expect anything. Yes, probably if you have a labor and all, 194C may come in, otherwise no. Insurance. Relevant? Not relevant. Yes, you don't pay insurance premium, pay TDS. That's completely fine. There's no insurance premium TDS. There is insurance commission pay TDS, not for you, for the other party. Yes. Next, we have net loss on foreign currency translation. This is what I said. Two things you will ask. If it is for a foreign asset, it triggers 43A. And next, if it is an MTM loss, if it's going to be MTM loss, that's a timing difference. To be disallowed. Yes, that is what you are going to say. Anything else will be allowed as a deduction. No doubts on that. Next, we have subscription, printing and stationery. Nothing. I don't know why people, there is a big question mark which is going on in the market. Yes, a lot of companies have this practice to go and print their flyers and all, right? Now they go to a printing company and they generally have a tendency to print flyers. Now by the time the year gets over, the flyers cost is obviously more than 1 lakh rupee. And so a question which has come in the market so many times, that when you go and do printing charges from a shop, does the company have to deduct TDS? 194C, ma'am. Tell me, is photocopy charges, Is photocopy charges, printing charges liable for TDS? What materials are you providing? The soft copy. Oh, so the matter is the raw material here. See, here's the problem, people. There's a huge dispute going on in the market right now. Dispute number one is they say, boss, I am only telling him to take a print, which means he is giving me the final product. This is 194Q, liable for 50 lakh limit. Liable for 50 lakh limit because he's selling me product, goods. Option number two, what people come and say, no, for photocopy or for printing, the material which has to be printed is given by me. And therefore, that's a raw material provided. Because it is a raw material provided, it is 194C. It is 194C because 194C says when I give the raw material, you make the final product. We call it as a job work. We call it as a job work. So a lot of people have come with this understanding saying photocopy na kurtadanaale, this is a job work. Tell me people, 194C will come, not come? Will come, not come? Definitely not come. Job work itself means that I should give a raw material having a cost. Having a cost, and when the person gives me the final product, he should reduce that cost and give me the final number. Yes or no? Do I have a cost on my photocopy? No, I'm only going to him and coming and saying, give me your photocopy cost, which means there is no job work model here, which means 194C should not trigger. Photocopy charges and all do not trigger TDS. Yes, companies don't recognize it. Companies will come and say, nahi re, risk kyun lena? Yes, they will literally go to the Xerox shop sitting outside. And on that guy, they are coming and saying, boss, 10 rupees ka photocopy, 1 rupee I will take back. 1 rupee leke baitha hai wo. Yes, because my company comes and says, no, by the end of the year, 1 lakh would be over. So why should I take a risk? Now 10 rupees also I will deduct TDS on that. मैं 10 rupees पे 1% TDS लगता है. 0.1 rupees you're taking out of it. वो देख भी रहा है उसको. Yes or no? Yes, people, these kind of stupidity and all you should not get into. Yes, just be careful. At least as a company person, you will get these questions, not as an auditor. But when you join a company, people, your AP team will come, your accounts payable team will come, and for every stupid thing, they'll come and tell, Rahul, I'm going to make 10 rupees to the chai kade. Will I give money TDS or not? मैं बोला पहले उसका पैन नंबर निकाल के ला तू. Yes or no? Yes, these are the kind of questions you're going to expect as an industry person, people, but it'll be fun. It'll be a lot of fun questions to. It's the stupidity you will see those people. No, you will also think once in a while, मैं CA करा क्यों करके. Yes, that is the kind of questions you're going to get, but nevertheless, that is how it is. Bad debts written off is going to be a allowable expense. Yes, if you have any provisions knock off, then you will take that into consideration. Then we have traveling and conveyance. Huh? Any problems? Okay. Visa expenses का? कौन? We have to pay commission to the person who's giving us visa. Okay. क्या section में? क्यों? Not that I know of. It's definitely not that I know of. People traveling and conveyance, basically, normally what happens in an MNC culture at least is that you don't book your tickets directly. You would have appointed an intermediary, something like Clear Trip, something like Make My Trip, all those people. Yes, obviously you're interacting transactions with them. They're going to charge you commission. They're going to charge you commission. On that, you can deduct TDS. You can deduct TDS. 194C contractual labor will come into picture. But yeah, other than that, if you're directly doing a transaction for buying a flight ticket and all, that's not liable for TDS. That's not liable for TDS. You're not looking that into considerations. Clear? Yes. Next. Factory supplies, repairs and maintenance, repairs and maintenance, repairs and maintenance. I don't see any problems here. I don't see any problems here. Then we have transportation. Now, transportation also generally is not an issue. But if you have received transportation for importing a machinery, or let's say you have incurred transportation costs for taking a machinery to your office, all those are capex. All those are capex because it should be added to the cost of the asset. Not something you're going to ask normally, but nevertheless, just clarifying it out to you. And then we have security expenses. We have puja expenses. What the hell is puja expenses? डिसअलाउ करते हैं. क्यों? क्यों? पर्सनल इन नेचर, नॉट इनकर्ड फॉर बिजनेस. हाँ, वही 37 ही है. होगा तो एक ही जगह होगा. You disallow puja expense under 37 by saying this is not incurred for business. True or false? People, India mein everything is incurred for business only. Yes, this is an allowable expense. This is definitely an allowable expense. They will not question on this. Yes, the only problem which happens in puja expenses is when you look at the daily ledger will have more than 10,000 payments. Yes, so that is alone what a trigger point can come. Your officer can come and ask, why did you make a puja payment more than 10,000? Now you may probably have to tell, sir, Pandit aaya tha, Pandit took 15,000 and went. Will he accept? Definitely will not accept. Yes, people, Pandit may ask for cash. You have to give it in online modes. You cannot expect cash payments and all. Pandit nahi le raha, Rahul, doesn't matter. You will trigger a disallowance. You will have to trigger a disallowance. There is no exception in income tax to make Pandit payments by cash. It's not permitted in India. Definitely not permitted in India. Will trigger a disallowance to that extent. Yes, finally. वो तो inform कर देगा तो अलग बात है. You can justify it to that extent, people. I have also done it. Yes, people come to me, they say, Rahul, puja expenses, I showed more than 10,000. I was like, yes, sir. There was Diwali festival. So I went to 4 different shops. One shop I bought this, one shop I bought this, one shop I bought this. 4 different people I made less than 10,000. What is the problem? Now it's petty cash, sir. I don't keep breakup of expenses and all. Yes, you have to trigger it to that extent. Yes, so you can ask these kind of justifications and all. Other than that, you can be smart. Why did you split it like that itself? You could have easily put it in your ledger itself as 2 different dates. It's 10,000 per day only, no? At the end of the day, it's cash payment. Which day you show, who cares? It doesn't really matter. But again, people, you can only do it in an individual structure. You can't do it in a company structure. Yes, company mein daily cash accounting hoti hai. Yes, to that extent, you can't go to your company manager, director and come and say, sir, we don't want a disallowance. Let's split it over the days and all. Yes, they will. The unethical, you can do it, not in a company. MNC companies, you can't do that. Yes, if you're having like a very basic company job, you be creative way, that's fine. This is a company from Netherlands as a holding parent. You think you can go to this company and talk unethical things? Okay, I am not going to recommend that as a CA at least. You can definitely do it. At least sitting in my company and all, people, if I go to my company boss and all, come and say, sir, it's a 6,000 crore company. We don't want disallowance, split it over multiple days. They'll throw me out. They'll definitely throw me out. Unethical things and all is not something which you and I can discuss upon. At least right now that I'm discussing this video with you, I'm talking ethical things. After we stop the recording, we discuss other things. Yes, but this is what is going to happen in the expense schedule. Clear? But this is what you will end up completing your tax computations. Yes, but if you notice carefully, after this itself, there are so many notes. Yes, now does this notes have any impact on you? Answer is technically no. Now, what generally happens is that this note is something which people normally use for RPT, is normally used for your 3 CBs. Your transfer pricing computation happens completely from here. So this note is the starting point for any assessing officer, which means if you have missed out to report something here, officer is also going to miss it out. His basis is only going to be this. He's going to take this into consideration and tell me that, Rahul, all these transactions, tell me what are the arm's length adjustments, what method have you used, what pricing have you used, is the transaction at arm's length, and how have you proved it off. So this sheet helps you prepare your complete RPT schedule. But if you're doing it only to that extent, people, you're unfortunately mistaken. Understand, this sheet has to be split into 2. One is all domestic parties and one is all foreign parties. To domestic parties, you trigger section 48.2. Domestic parties, you trigger section 48.2, which means even domestic party transactions have to be benchmarked to confirm that it is within fair market values. Yes, so that also needs to be done. Unfortunately, people don't end up doing it. Yes, but nevertheless, that's always a question which can come up. I've seen so many cases, people, that assessing officer would come and say that the director of the company is reported here, and so therefore whatever salary you've paid to directors is not at arm's length. It's not at arm's length, and they start disallowing director salaries. My question is very simple. A director is an employee of the company. He may be a related party because he has substantial interest, but at the end of the day, he's a director of the company. On what grounds did you tell him that I'm not paying him as per market standards? Yes, so he will have to create a basis for himself. He will start creating basis saying, last year the company was doing 100 crores turnover. This year the company is doing 80 crores turnover, which means company's turnover has decreased. But if I notice the director salary has increment 15%. This is a classic live case. I have a case in my hand where the company came and said that the company's revenue has fallen, but the director salary is increasing. Why is the director salary increasing when the company's revenue has fallen? Therefore, they triggered the differential as a disallowance. And my question was very simple. Sir, you're telling me this when the revenue is falling. When my company is making losses, I should pay no salary to him, is it? That's not how it operates. A company may make a loss or a gain. That's not director's risk. Director here is an employee, which means he will get his standard salary. That's how he is joined as an employment. Had he wanted to do business, he would have done it differently. The point that he's joining as a salary means he doesn't want to take the risk of the business, which means regardless of what business is doing, a market practice is to give everyone 15% increment. That's what I have done. So you cannot take that as a defense point to treat a disallowance, and we won the case. We definitely won the case, but nevertheless, that's how the kind of questions you can expect also from an accounting perspective. Clear? So this schedule helps you on 40A2 along with TP3CB. TP3CB. After that, people, you will have a few other items which I generally don't have a tendency to look into, items like capital commitments, items like these. But here, sometimes a lot of companies give a very, very beautiful disclosures, items like contingent liabilities, which come and talk about all pending litigations of the company. And this contingent liabilities is actually very beautiful, because what happens is sometimes you will see that the contingent liabilities will confirm that the appeal has been won, the appeal has been reversed, all those kind of favorable outcomes to you. Ask questions, give the order, understand what kind of favorable adjustments you've got, because after a favorable adjustment automatically follows a refund order, and with the refund order you can expect an interest. So those are the kind of questions you should ask. But at the same time, you should also be worried about what kind of outcomes have come from that order, because if the order outcomes were unfavorable and you are not planning to go for a further appeal, you should take those disallowances into current year consideration also. Yes or no? Because if you don't take those disallowances in current year consideration, an officer can say after the appeal order has come also, if you're not making those disallowances, you are technically doing a fraud, and that triggers penalties. So it's also important to know what is happening in the past litigations. That comes from the contingent liabilities. Second, if there is any business restructuring happening, amalgamation, demerger, change of shareholding, any kind of liquidation proceeds have been started, all those have to be disclosed as a separate line item, because we have a going concern concept. Yes, that helps you ask beautiful questions on slump sale, on amalgamations, on demergers, and all those kind of question materials. Yes. Now, why is amalgamation demerger relevant, people? Because anyway it is exempt. The reason is because if amalgamating company, the old company, was claiming any kind of 5-year differential treatments, there are expenses like preliminary expenses, there are expenses like VRS expenses. If those expenses were being claimed by the amalgamating company, then after amalgamation, this company can claim for the balance period. Which means if you're going to have any such structures, you will go and ask that company that, sir, you amalgamated this company, show me that company's P&L statement, or show me that company's computation statement. If in that company's computation statement you see something called preliminary expenses, this is the second year of claim, or VRS expenses, this is the fourth year of claim, then the balance claim will be claimed in this company. That has to be taken into consideration as well. Yes, that is how you do a restructuring structure. Make sense? Very good. This is how you review a financial statements. One second before I close. Yes, after you do all these reviews, people, you will then start preparing a computational statement, and then you will ask the question, which regime looks beneficial? If you end up claiming MAC credit in your normal computation versus claiming your special regime, you will check which one is beneficial, and according to that you will advise your client saying, sir, let's go for old or let's go for new. If the company is already in old, you have a chance to go to new, but if the company is already new, then there is no discussion. You are continuing with the new. There is no discussion otherwise other than that. Yes, at this stage you will then ask whether you should file any forms, is there any certificates to be issued. All the certificates, if you remember, we wrote in our golden rules. Yes, you will give those certificate issuances, complete your filings of CBCR master file, and then make your final filings of. That's how you complete a tax computation and satisfy yourself along with the client, saying that you have done the best of the reviews. Make sense? Yes.